Tom Boley, Chief Market Strategist here at Earnings Beats. Hey, good morning, everybody, and welcome to this Wednesday, May 15th, 2024 edition of Trading Places Live here at earningsbeats.com. I'm Tom Boley, Chief Market Strategist at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for yet another market open. Can't believe it, but it's already the middle part of May. Shocking, actually. Seems like, didn't we just flip the calendar on 2024? Anyhow, market is continuing to try to hum along. It was interesting yesterday. The headline number and the core PPI number came out, and it certainly at the very beginning looked like it was a really hot number. We came in at the headline number with a rise of 0.5%. Market was expecting 0.3. And then when we strip out food and energy and we move to that core PPI number, we also came in with a rise of 0.5%. But the market was only expecting 0.2. So it really looked bad. And immediately futures went down until you read the fine print. I do want to thank, I'm not sure who it was, but in the chat yesterday, I had mentioned, hey, if you know what's going on, let me know, because I hadn't followed through on it yet as it came out right before the show started. And someone had mentioned that the prior month's PPI readings had been revised lower by 0.3%. And so when you factor the two in, when you lower the prior month by 0.3, obviously that's going to increase the following month over month, by that 0.3%. So really, it wasn't an increase at all. And the market, after quickly moving lower in futures when the report first came out, rebounded. And actually, it was a pretty good day on the market, which we'll go over in just a few minutes. But I did want to mention that. Also, this morning, we had the April CPI number come out. It wasn't great, but it wasn't bad either. We came in as expected, with a rise of 0.3%. I kind of alluded to the fact that I thought the market would respond favorably to just coming in as expected, because we have had some recent, I wouldn't say shockers, but certainly disappointments. If you've been bullish and expecting or looking for or hoping for, I don't know what the right word is, for lower inflation readings, it hadn't happened in the past few months. The market's been a little bit jitterish because of that. So I think coming in at expectations is actually not bad. And the market, at least futures this morning, have turned up as a result of that, which I think is a good thing. But maybe the more important thing was retail sales, which came out this morning, and they came in flat. The headline number, and then also if we take out the transportation, it was flat. And both of those readings were expected to be positive. I believe the headline number is supposed to be a rise of 0.4%. Also, the March retail sales number was revised lower. So we're starting to get more and more readings that suggest that the economy maybe is starting to slow down a little bit. Remember, we had the jobs report come out that came in below expectations. Initial jobless claims, which we'll have tomorrow morning, but last Thursday came in well above expectations. Big jump. I think it was like 10% above expectations. And now we've got retail sales coming in lower than expected, with the CPI as expected. So I think that combination is at least maybe having the Fed think more about the likelihood of cutting rates sooner rather than later. Don't know how that'll all go down with the Fed, but at least that's the way the market appears to be reacting to this. The bond market today, lots of buyers jumping into bonds this morning with that news, with the yield dropping significantly. And we're going to take a look at that chart here in just a minute. But let's go ahead and jump into those charts. Take a look at what happened on Tuesday. So let me see if we can get these in here, zoom in just a little bit so you can see these a little bit better. Dow Jones Industrial Average finished up 126 points. That was up 0.3%. Spider, or the S&P 500, I should say, up 25 points. That was up almost 0.5%. You can see both these indices not far off their all-time highs. S&P 500 literally could be there at today's open. We'll see how things transpire into the opening bell, but with futures up, we may be at an all-time high on the S&P when the market opens. The NASDAQ 100 up 0.2%. That was up 124 points. It too is right up against resistance. I believe the NASDAQ itself closed at an all-time high, although intraday it has not made an all-time high, but that should be taken out at the open as well, as long as the futures hold up. Mid caps rising almost 1%. So relative strength here in the mid caps, jumping 29 points, finishing on the high. And by the way, we're seeing those AD lines strengthening, especially look at the S&P 500 getting back up close to its high. The Dow Jones got a little bit more work to do, but obviously they are heading in the right direction. So this is starting to show more and more signs of accumulation, which is good. I think it just confirms what we're seeing on the charts and what we've been talking about. Fact that, I believed we're going right back up to all-time highs, and it looks like we might be there this morning. IWM, Russell 2000, up more than 1%, 1.04%, gaining over $2 yesterday, finishing in the upper end of its range, but not quite as strong, at least, finishing-wise as some of the other indices, but still leading in terms of percentage gain, up more than 1%. Transports, on the other hand, bearish engulfing candle. I've been talking about the fact that, hey, it's been moving up. That's been a positive, but it was still among the weaker groups. And yesterday, it did not even participate. We got a gap up. We set a new high intraday, and then we rolled back over. We were below the 50-day moving average intraday, but we did manage to close just about on it. We'll see what happens with the Bright futures this morning, see if transports can get going. That is something that I think we need to see to really believe in this rally, especially if you're looking at many of those Dow Jones component stocks. Transports would be really helpful there. Technology back at the top of the leaderboard for a second day, gaining almost $2 and close to 0.9%. Been straight up, clearly well above the 20-day and the 50-day now, and the 20-day is rapidly gaining on the 50. So we may get that golden cross sooner rather than later. This one's been slow to see its AD line turn up, though. So that will be one thing I'll be watching to see if we continue to finish strong. We don't want to, just be this morning wonder where we jump up in the morning and then we sell off all day long. That's not a good look on the chart. So we'll see whether or not we can finish strong. But I imagine volume is going to be pretty heavy today, given that we're in option expiration week and the fact that we've got some leadership coming in from technology again, and a calm or maybe a tame, whatever you want to say, CPI report, strong futures. It seems like this morning should get off to a good start. We'll probably see some volume. So how do we finish today? That's going to be a big question. The XLRE did break out above the 50-day moving average. It was the second best sector yesterday, gaining more than 0.7%. Financials getting close to a breakout, jumping up about 0.5%. Most of that at the opening bell, though, yesterday. Didn't really add on during the day, but we've got to clear about 42.20 or so. If we can get through that level on a closing basis, and again, maybe that happens today, that would be bullish for the financial group. Automobiles, looking at individual industry groups. Automobiles tied non-ferrous metals for honors yesterday, both gaining 2.77%. Clearly, non-ferrous metals already making a breakout. That's a nice looking ascending triangle. You can see equal highs there, rising lows, got the breakout. So the way these ascending triangles work, I call them A, B, C, D, E patterns. A is that initial high off an uptrend. Come down to your first low is B. You go back up. Well, let's get a little bit bigger look here. Let me zero in here. So B comes down, sets that first low. C goes back up and tests the prior high. Come back down, put in a higher low. That's D. That gives you the upsloping line there, trend line. And then you go up and you break out above both A and C. So you got A, B, C, D, and then E is confirmation. Big breakout, volume increasing, really nice looking breakout on non-ferrous metals. And by the way, this index is pretty much Freeport-McMoRan. FCX is the symbol. So FCX obviously having a strong period here over the last 5 or 6 weeks, or at least a a continuation pattern developing and now breaking out of that continuation pattern, which is a very bullish development. Anyway, getting back to autos, autos a little different story. Autos gapped up a few times, didn't really show a lot of, I mean, we did have one really good day in here, solid hollow candle, but really that was the only one. Maybe the top here saw a little bit of movement to the upside in the AD line, but on this pullback, we have seen that AD line really drop, meaning that we have not been closing well. And even the last 2 days when we moved higher, we've struggled to move up in the AD line because we're leaving these long tails to the upside right there. Hopefully you can see those. But we're going up intraday, but then we're backing off in the afternoon. That's really not what you want to see. We want to get some strength in the afternoon. So if there's one thing lagging, or not lagging, but lacking for the autos, it's that AD line. AD line keeps going down, and we're trying to go back up again. I'd like to see a really big, heavy volume, hollow candle that's like a Maribozu candle where you've got your open is your low and your close is your high. Basically, you gap up and you just go up all day long. I did see Tesla earlier in pre-market up about $4. So we'll probably get another gap up, but the question is going to be, do we hold it? Do we build on it? And that's been the problem for the autos lately. Last one is the durable household goods. And here you've got a breakout above the 20. Obviously, we had some support back here at about 134. Then we had the reaction high go up to about 135. Couldn't get through the 20-day. Recently, we went up to the 20-day and this 135 level, struggled. And then the last 4 days, you can see very solid break to the upside. So this is one of the groups within consumer discretionary that is strengthening. It'll be interesting to watch it because we do have a lot of overhead resistance up at around that 150 level, might even run into some around 146. But with futures up, maybe we're poised in this group to go up and test those levels. That will be something to watch as well. Moving on to the 10-year Treasury yield. So I mentioned the bond market earlier, the fact that everyone's moving into bonds today, sending the yields down. Remember, bond prices and bond yields always move 100% inversely. Always. It's just the way the math works. When you're buying a Treasury and that Treasury price goes up, the yield comes down. So anytime you have a big move down in the yield, it's telling you there are a lot of folks moving into bonds. Now, would you move into bonds if, with a yield of now 4.3%, if you were worried about inflation? The answer should be no. I mean, if you're worried about inflation, you should require higher yields. I mean, if you think inflation's going back up to the highs that we saw, 6%, 6.5%, I think it core CPI topped out around 6.7%. If you think you're going up there, you don't want a 10-year Treasury yield that yields you 4.36%. You're losing money. So bond market is a guide for us. Interest rates go up and down really based on just a couple of factors. One is economic strength or weakness, and the other is inflation expectations. That's what drives the bond market. And I think what we saw through the first 3 or 4 months of this year was the bond market reacting to some disappointing inflation news. The fact that it kept coming in higher than expected. Fed speak, talking about, instead of 3 rate cuts, we might not have any at all. And some of the Fed folks going out talking about maybe we might have to hike again, which I kind of chuckled at, but that's what you get with Fed speak. You get all kinds of talk. And I think a lot of this movement higher in the 10-year Treasury yield had much more to do with inflation worries than it did massive economic strength ahead. I think we're seeing in some of these economic reports that we may still be okay with the economy, but it is not exactly full speed ahead right now. In fact, looks like maybe a few cracks in the foundation. So I believe that the fact that these yields are coming down as rapidly as they've been now during the month of May signals to us that the bond market anyway is not looking at inflation as being a big problem right now. I don't know how else to view it. It also could be that the bond market is reacting to some of the things I've talked about. The fact that it does look like the economy is slowing. And, with that, inflation expectations normally would drop. And so that combination is sending it lower. Very possible. But that combination, yields going down and the stock market going up, is music to the bull's ears right now. Moving on, S&P 500 got a little bit of a cup, still working. Yesterday moved up, got very, very close to the breakout level. Let me give you those numbers. On the S&P 500, the highest intraday level was 52.6485. So that is 18 points above where we finished yesterday. And so that would be roughly 0.3%, maybe 0.5% for the S&P to go up to set a new high. Right now, the spider, we've got 15 minutes to go, but the SPY, which tracks the S&P 500, is up 0.5%. So if we open according to where the spider is trading right now, we will be at an all-time high at the opening bell on the S&P 500. Now, is it going to be a gap up and a continuation? Or is it going to be a gap up and failure where we come back down, maybe put in like a bearish engulfing candle? Because that wouldn't look as good. So getting to an all-time high is quite an achievement short term, but where do we go from there? I think we're going to be looking for some follow through. At least that's what I'm going to be looking for. NASDAQ 100, also probably getting close to that all-time high at the opening bell today. That number, intraday, I'm giving you the intraday numbers, 18,464.70, which is 142 points, which would be maybe about 0.8%, between 7 and 0.8%. And right now the QQQ is up 0.54%. So right now, based on futures, the QQQ would open just a tad beneath the all-time high. Moving on to the IWM, doesn't look like we're going to get the number that I was hoping for here. IWM, I was looking at the candle bodies, and we needed the high open or close was actually the open on April 1st, which was at 210.77. Right now we're at 209.26. So I was kind of hoping we might get that opening gap above that 210.77 level, unless we have another pretty good push into the open. Probably not going to happen. So the question is, do we get through intraday and set an all-time high? Do we just simply go up and test, fail, maybe come back down? This could be a cup, potentially. We could have a handle to come back down maybe for next week or so with options expiring this Friday. Lots of different things on this chart that I see could happen, which isn't particularly helpful. But the longer term, I'm clearly bullish. I believe we're going to break out if it's not today or if it's not this week because of options expiration. I believe by the end of this month, you're going to see our major indices either at all-time highs or at least 2024 highs in the case of the IWM. Let's see. Next up, let's take a look at the transports. This is what I mentioned earlier, and let's zero in on this one. Kind of important here because that is a bearish engulfing candle. Usually when you get those, you follow through to the downside, especially off of an uptrend. But if the market's going up, our transport's going to go back down again. That happened yesterday. Market was up nicely. Transport's down. So I'm not going to rule it out, but a little bit of a mixed picture here in the market because of the weakness that we've been seeing in the transport area. All right. Let's keep it going here. First of all, if you are new to Earnings Beats, please come in, check us out. We've got, first of all, a free Earnings Beats Digest newsletter, name, email address, all it takes. It's a 3 times a week newsletter. And if you're thinking, oh, I don't have time for another newsletter, it's 2 paragraphs in a chart. Many times it could be a trade setup if you're so inclined. Of course, that's completely up to you. It's your risk. It's your responsibility. But I do provide charts of individual stocks that I like, sometimes from a short-term trading perspective, occasionally from a long-term perspective. but we talk about a lot of different things. If you'd like to check out our service, we have our live trading room coming up in about 40 minutes. It starts at 10 a.m. every Wednesday morning. Last 2 weeks, we've provided 5 stocks in the room, and all 5 have gone up. We've made money on them. So we're going to try and keep that streak going. And today, I can tell you that there is a short squeeze stock, a potential short squeeze stock that is way under its max pain level. So it could go higher simply based on max pain. But there are a lot of stocks that are heavily shorted that have really been running over the past week or so. I did an EB digest on it sometime last week, and I pointed out a large number of stocks that had started to perform well, and ones that I think I pointed out in there, the ones that had shown some really good volume to boot. I can't remember, but I think it was the volume or maybe it was the PPO. I don't remember what I featured. But since I posted that, these stocks have absolutely exploded. I mean, exploded to the upside. But there's one in particular that I'm looking at that has a max pain that is 60%, almost 60% above the current price. And if this thing gets going, there could be some market maker involvement to short-term drive this up and wipe out a lot of in-the-money put premium. This is a unique kind of a situation. I haven't seen, I can't remember seeing one like this. I bought the stock in after hours last night after our Max Pain webinar. That's when it came to light. And I'm going to be looking at this, talking about it as soon as our trading room opens. So if you want to try our service for 30 days and come in and check out this stock, I mean, you can't guarantee anything, and a stock may not even go up. There's nothing that guarantees it goes up. But I do think that there is a strong potential for this thing to make a big, big run this week. So anyhow, check us out. Start your no-cost trial. By the way, we're also kicking off our spring special soon. So it's a great time to come in and try us. It's free. You do have to give a credit card to sign up. We've got to get you in our system. We have to have that to set you up. But other than that, you'll have a completely free 30 days to check out the service, check out the stock. I'm going to be talking about at 10 a.m. So hopefully I will see you there if you're not already a member. So the next, actually, I wanted to show you GME, because GME was a stock, and if you recall, this was another stock that had a huge short squeeze. I don't remember if it was back in 2020. I think it was. We could take a look at the chart, or you can look at the chart and go back. But the stock ran from $7 in September to like $500 in January. It was like 4 months later. I featured it on the EB Digest newsletter. And I remember the headline was something like, "This could be the mother of all short squeezes." And that was in September. I believe GME had a short percentage of float of 140%, which I had never seen in all the time I've been in the market. I have never seen anything even close to 100%, but above it was crazy. It's almost like borrowed shares are being borrowed. And I think some of the rules changed after GME because of that massive move it made to the upside. But anyway, yesterday I was pointing out on GME that there were almost no puts in the, this is the open interest over at CBOE. This is the open put interest. And yesterday, I pulled this up today, so you're going to see a difference. But yesterday, when you got up past about $30 to $34, there was almost zero in the money puts. And after yesterday's massive move to the upside on GME, look now at all these open puts that have come in. So now we've gone from basically zero to thousands of in the money puts. So that max pain level is rising very quickly on GME. I did not calculate it. Last night I calculated max pain at 1701, and the stock closed at $48. Today that max pain level is going to be a lot higher. So just wanted to point it out to our members and to everyone. I mean, this is how quickly things can change when these stocks make these huge runs. GME was already heavily shorted before yesterday, and I'm sure there were a lot of folks jumping on board shorting. You can see from the in the money put interest, or not in the money, but just put interest overall, all of those, all of that open interest now above that 34 level, there are a lot of folks taking the other side of this trade now. Going to be really interesting the rest of this week, maybe even into the early part of next week, as a result of all of the option activity to go along with Max Payne and monthly options expiring this Friday. It's going to be wild. And then throw in the CPI report today, slowing economy, dropping yields. Going to be a fun one. Anyway, chart of the day today, I haven't sent it out yet, so you're going to get a sneak preview here. But I did want to mention copper. Copper has been going crazy. You can see it over here. This is a 20-year weekly chart, and I'm going to come back to this in 1 second. But let's look at the daily. Actually, yeah, let's look at the daily chart here. So look at this run that copper has been on since February. 370 up to 490. That's over a 30% increase, probably close to 33% increase in copper prices in just the last 3 months. Now, the first thing you're probably thinking is, oh no, inflation. You know, when you're starting to get commodities like copper moving up like this, you might think inflation. I think it's a sign that global economic activity is improving, that demand is growing. I want to show you this, and you might be surprised, but the direction of copper and the direction of the S&P 500 is pretty positively correlated. So let's go back now and take a look at that weekly chart. I want you to look at the periods when copper takes off. 2004 to 2006, 2009 to 2011, 2016 to 2018, right after the pandemic, March, April 2020, through the early part of 2021. I mean, that's when the majority of it was felt. So maybe through the first half of 2021. And now again, as we move up and going straight up. Today, let me give you the numbers on copper right now. Copper is at 492. It's up another 2.6. So it was about 490. Yesterday, where did we close? 489. And I can zero in here. There's your 489 close. And today it's at 492. So it is continuing to rise, and it's threatening $5, which is the level that we saw. That was the high that we saw back at the beginning of 2022 in the first quarter. So we're threatening a breakout. Now, why is that important? Well, let's look at the S&P 500 first, and let's see what happened during those periods when copper went up. 2004 to 2006, S&P goes up. 2009 to 2011, S&P soars. 2016 to 2018, S&P soars. 2020 to 2022 or 2021, S&P soars. This year, copper going up. What's the S&P been doing? It's been going up. When copper goes up, so too does the S&P 500. That's the history. This is a 20-year weekly chart. And what I like to do is highlight, and you can do this pretty easily. I like to, usually with correlation, I like to use the blue. Choose that, do that, and that should work. But what I'm looking at, positive correlation is seriously positive correlation, is when you move into a range of 0.5 to 1. 1's the highest you can get. If you get to 1, that means whatever you're looking at, those two assets or asset classes or stocks or whatever you're looking at, those two basically go hand in hand in the exact same direction when you get up to 1. But anything above 0.5 is very strong positive correlation. Then on the flip side, if we go in here and we look at when it is heavily inverse correlation, heavy inverse correlation, that's what it would look like right there. Now I want you to look at this chart and tell me how often, or are we more often in this blue shaded area, or are we more often in this red shaded area? I think it's pretty clear that we spend a lot more time up here in the 0.5 to 1% range than we do the opposite, minus 0.5 to minus 1. Only in the last 20 years, we've really only seen 4 meaningful moves into this, where we've gotten down to 0.75, let's say, minus 0.75. But look at how often we've spent at 0.75 or above. Clearly, there is a positive correlation between the price of copper and the price of and the direction of the S&P 500. So just wanted to point this out, because the other thing that I had mentioned probably in the last several months was that there was a symmetrical triangle that had been going on here for a while. And you can kind of see that it was squeezing off of an uptrend. Symmetrical triangle normally breaks in the direction of what? The prior trend, which was higher. What did we do? We broke out and we moved higher. So, and you could maybe draw these lines just a little bit different. I could have probably moved that down to about there. Could have maybe put that up to there, maybe moved that to there. No matter how you draw the lines, though, we have a clear breakout at this point, back to the upside. So just wanted to point it out. This is another reason why you should be pretty happy about copper moving up, and the fact that it's just one more signal that tells us stock market's going higher. Let's get out of that because it is 9:31. Let's see where we open today. We've got the Dow Jones right now up 195 points. S&P 500 all-time high, 5271.53. The NASDAQ, I can zero this in so you can see a little bit better. NASDAQ up 90 points. That's up 0.5%. Small caps up 1%. So clearly showing that leadership. Getting off to a good start, as I said earlier. And by the way, look at the VIX back down below 13. Below 13, it doesn't get any better than that for the stock market. When the VIX is below 13, that's when the stock market historically does its best work. So, and it does really well from 13 to 17 as well. So I don't want to downplay. I don't want to say that, hey, 13 is the level. Anything below 17 and the stock market tends to do extremely well. But when we go below 13 and stay below 13, that's when things usually get very, very boring. And I can't tell you, I can't overemphasize the fact that I love a boring market, because that just means we're just going to keep going up and up, drifting slowly but surely, driving the bears absolutely nuts. Anyhow, that's all I got for today. Everybody have a great day. And remember, 28 minutes from now, we have our live trading room. Don't forget, got a stock for you. You don't want to miss this one. So hopefully see you in 28 minutes. Have a great day, everybody. Happy trading.